Well, we're back with you to keep an eye on your ag commodity trade. And just a little over 24 hours from right now, we'll be getting USDA's report numbers. It'll be our crop production and our supply and demand report numbers. And here to talk about it, we have Scott Gecas with us. And he is at the trading floor in Chicago. He's with Walsh Trading. Scott, I wonder, I know you work a lot with the options markets, and sometimes that can be kind of telling as far as which way the market is kind of leaning based on the way that the premium structure is set up on the options. What have you noticed here this morning as we get into those reports tomorrow? Are there any clues on how the trade thinks the report may come out?
Well, that's very interesting. So when you look at the option market and you look at expected moves after the report, as well as the historical day, 20-day historical volatility, as well as the implied. Now, going into yesterday, the historical volatility was it was roughly in the 20s. Implied volatility was also in the 20s. It was very flat. You typically see that going into a report. But yesterday, after that big move, so we had short covering because all the traders are net short as well as all the funds. And so you had a little bit of short covering as well as the China news that broke yesterday saying that they're going to import a little bit more ags. We had a little bit of strong move up. So that implied volatility kind of exploded a little bit. For soybeans, the skew went to the call side. Corn went to the call side as well. Wheat went to the put side. But what's very interesting to me is after that big move coming into this morning, the implied volatility is still elevated. But when you're looking at all the option flow, the puts are a lot more active than the calls. So that's a little bit odd. It's a little bit concerning going into this report. With the report with a wide range of numbers coming out, estimates are all over the place between private numbers as well as analyst estimates. So I'm not even going to talk about expected range or expected numbers because they're really wide all over the place. We just have to wait and see how that's going to come out. But right now, when you're looking at the option flow, soybeans or puts are a little bit more active. Corn is a little bit more active as well.
All right, let's take a look at our futures then and see just what they are up to. We had a softer tone this morning on the open, and we're maintaining that. However, it's come off of its earlier lows here by roughly about a penny. December corn down 3.5 now at $3.58 per bushel. And if we look at our soybean market, our new crop November contract is now trading 5.5 lower at $8.66.5. That would be off of its low of the day by 2.5 cents. And if we look at Chicago wheat, we'll go there first. December now down 6.5 cents at 4.75 3/4, within a penny of its low of the day, off our overnight high by about 7 cents or so. Kansas City wheat on December is now down about 5 1/4 at 3.98.5, and Minneapolis wheat all by itself is trading about a half-cent higher. Let's pause for a break here, Scott, and then we want to get your thoughts on our livestock trade. It's been quite a week here so far. We'll see if it's going to be changing any today when we come back. All right, we're back with Scott Gecas of Walsh Trading. He's at the edge of the trading floor in Chicago. We talked about the grain side. Let's take a look at livestock. And the market has been trading firmer this morning on live cattle. It was led by the nearby contracts. That hasn't changed. In fact, if anything, we're adding to the gains. Right now, we have October live cattle. We're up $1.72 now. And we have the December up $1.75 for the biggest gain here. It's now at 102.97. It did peak up above 103 momentarily there. On the feeder cattle side, are they following suit? Well, so far, they definitely are the biggest gains on the nearby contracts. September is up 222. That active October contract, it is now up 297 at 134.03 after a low this morning of 131.10. That's almost a $3 gain off of our early lows this morning. And November up 275 at 133.45. Meanwhile, in the lean hog trade, up to this point today, we have the lean hogs still showing some big losses here. October down 248. 60.25 is our last trade, and we have the December down $1.27, and it's now at 60.50 on the day. At least $1.27 or $1.20 to the lower side here, all across the board on the lean hogs. All right, first on the cattle, why the rally in the cattle market versus the sell-off in the hogs here?
All right, so with the rally in the cattle market, you have two things that are going into play here. Number one, it's a technical level. Couldn't find a lot of sellers below that 99, so as soon as that selling stopped, the buyers came in, took control over it. That's why you're seeing a little bit of elevated prices. Now, with the packer margins, they're having a little bit support to the cash. That's also a bullish catalyst to it as well. Now, you got to keep in mind that everybody was worried about that plant being closed and whether or not they could keep up with the slaughter rate. So far, the slaughter rate has been holding steady, so that's also another bullish catalyst to that. That's why you're seeing a little bit of a bump up in prices. Now, with the hog market, everybody I've been talking to is pretty much scratching their heads. So everyone was worried about the exports coming in. Exports to China are pretty strong. Mexico started having imports. So that led to a bullish catalyst. However, prices are very suppressed. The thing that really sparks my interest out in hog market is when you see major news outlets that typically do not cover the commodities or cover pork prices just in general. They are coming out saying that there's such a high demand in China that it's almost an epidemic, that they need U.S. pork, yet pork prices continue to slide. So everybody I've been talking to, as far as the hog prices, they're pretty much scratching their head. Everyone's expecting the hog prices to get a bump up in price. It's just not reacting. And the market is definitely showing that it's got downside pressure.
Boy, I've heard that time and time again over the decades. When it hits the mainstream news, then look out. Thanks, Scott. Good point. Thanks for pointing that out. Scott Gecas of Walsh Trading, and he's right there in Chicago.